G'day expats, ladies and gentlemen. We're back with another episode of Expat Chat, episode 170. We're doing a bit of Q&A today from our Australian Expat Financial Forum Facebook group. Today, I've managed to drag him back on again, one of our specialist financial planners here in the Australian office. Good afternoon, Martin. How are you?
Hey James, yep, doing well. Good to be back on for another episode.
Absolutely, mate. Brett's got his hands full with everything going on in the Middle East at the moment. So I've pulled you
Yep.
back in and I reckon you and I are going to do a few more episodes the next couple of weeks, depending on what's going on over there. Some great questions are coming through on our Facebook group. So if anyone's listening in today, if you're not aware of it, got a Facebook group which a lot of clients and a lot of Australians are in. There's a lot of things that are jumping around in there at the moment, but even a lot of expats just helping other expats out in terms of questions, things that they've solved. Before we jump in to the Q&A today, a quick disclaimer for all the compliance lawyers and officers out there. Anything you hear today on today's episode or see on YouTube, if you're watching us on YouTube, is just for information or education purposes only. It's not personal advice by any means. It's general in nature. And should you need any personal tax financial advice, please feel free to reach out to us or a qualified registered professional. Now, Martin, Jack, some good questions here that I want to pick your brain about. Um, well, the first one is a bit of a long-winded one, so I think we'll come back to that one. I want to do that one as the last one because I think we can unpack it a little bit. Let's
Sure.
start with property because we do get asked a lot about property. We returned recently from the US and property came up a lot in the Q&A session. But what CGT or capital gains tax traps hit expats selling Australian property whilst they're a non-resident? And how can timing these sales be, I suppose, done for better outcomes?
Yeah. Very, very common question. I think we've touched on it a few times. I know I've
Mm,
spoken to almost all my clients about it, at least all of those who own property. It also comes into the decisions when you actually just consider whether I should buy property as well,
mm,
because this sort of tax trap. Yeah, I mean, the big one that jumps out is the main residence exemption. So that was removed, back in sort of 2019, 2020 timeframe. Basically, if you sell that property as a non-tax resident of Australia, you're no longer entitled to that main residence exemption. Even if you've lived in it from the early 2000s for the last 20 years, it's been your home, you move overseas, you become a non-tax resident, and then some buyer's agent comes knocking on your door saying, hey, I'm going to give you $2 million above market price. They're still going to tax you under the entire gain, even though you've only been a non-tax resident for one week in that instance. It's the contract sign date is the CGT event, and the main residence exemption is no longer applicable to non-tax residents. So you would pay taxes over that entire gain there. Whereas if you sold it just before you left and just before you became a non-tax resident, you'd be entitled to that main residence exemption.
mm,
So that's the biggest one. I think that links in, well with timing of the sale as well. So
mm,
obviously the opposite of that coin in terms of selling it as a non-tax resident is actually trying to sell it as an Australian tax resident because A,
mm.
sell it before you leave makes sense, but then
Yep.
B, you can come back to Australia, recommence tax residency, and there's this tax law called or concession, I should say, that's called the 6-year temporary absence rule. And what this rule allows you to do, it allows you to convert your former main residence into an investment property. And for a period of up to 6 years, you can treat it under the main residence exemption, so long as when you sell it, you're an Australian tax resident.
Mm,
So if we
yep.
think about timing, you could be overseas, you could spend 5 years overseas, you could be in Singapore, the US as an example, come back to Australia, commence tax residency. Really important that you actually do the steps to support that tax residency commencement. And now you're entitled to that main residence exemption for the entire time frame there, plus 6 years on top of that, potentially a completely tax-free sale at that stage. So
Mhm.
yeah, that's certainly the big one there. I suppose another one to just touch on is that 50% capital gains tax discount. So that concession was removed for non-residents back in 2012. So for any period of ownership as a non-tax resident after May 8th, 2012, you don't get the 50% capital gains tax concession at all.
Yep.
So yeah, I mean, that's obviously a bit of I don't know if you call it a tax trap, but it's just more so being very conscious of that concession that you forego and whilst the gains on your property might look fantastic on paper, if you're planning to live overseas for 10 years and sell them and retire in Italy for the rest of your life, and then you're paying 50% or you're paying taxes on that entire gain without 50% concession rate that you would ordinarily receive, it's going to be pretty impactful when you actually incorporate that as part of your plan.
Absolutely. And I think that's something actually everyone's going to be watching pretty closely just in general on that tax concession and the main residence exemption when we see the May budget come out. I think everyone
Mm,
just is confident that Labor will put something in there regarding updating or reducing the concession in general to try and combat maybe property prices. But it's pretty severe not being able to access the main residence exemption as one, and then the CGT discount as well. If you're only ever owning an investment property as a non-resident, it's like, oh, well, okay, all my gains are taxable technically because I don't get access to the concession. And then unfortunately, our tax rates are pretty severe in Australia. So
that's
it
right.
it does lose the polish, but property is a really good asset to gear in Australia as well. And I know for a lot of our clients, they love property, they love investing in property as part of a broader diversified strategy. But it's just those concessions that we miss out on now. And even that foreign resident capital gain withholding tax, that's not a concession, but that's a nasty little surprise when people sell a property and they're a non-resident. It's nothing to do with, I guess, concessions. And I'm sort of expanding on the question now a little bit here, but that 15% withholding tax that applies, but you get it back if you're overpaying tax. But I won't deep dive into that one today. We can touch on that one probably on next episode, actually, and we'll explain it a bit more. Another question for you here, Martin. Can non-resident expats access early super without penalties? And what happens to withdrawals taxed in host countries like the US?
Immediate answer would be no. Probably a little caveat there. If you're not an Australian citizen or permanent resident, then you can do a DAS payment, which is a departing Australian superannuation payment. You pay some pretty hefty taxes actually under that sort of arrangement. But if you're an Australian citizen, you don't really have any options. So can you access it early? No, you need to meet a sort of condition of release. And the most common one is meeting your preservation age, which is really just age 60 and full-time retired, or beyond the age of 65 if you're still working as well.
Yep.
So can't access those funds anytime earlier outside of a DAS payment if you're not an Australian citizen. So usually temporary workers, if they come do a little bit of work here, get the employer super guarantee payments, and then just want to take those funds out, pay a chunky amount of tax on the
Mm.
distribution there. Specifically to the US, I think the back end of that question was how would the US tax that, I suppose.
Yep.
Yeah, not very favorably. They do treat it as ordinary income. So if you've got a large super fund, let's say you've retired, you are over the age of 60, you can release all of those funds if you want. If you've got $1 million in super and say, great, you know what, I want to use that, use it to buy my forever home over in the US, and AUD is really strong right now, so let's move the funds across. You make that full distribution, you're going to pay income taxes over in the US on that entire distribution. So you're going to pay a very large amount. Naturally, you won't get any foreign tax credits whatsoever because it's tax-free here in Australia. So
Mm.
Australia, super's agnostic with your tax residency status. So they don't really care, regardless of where you are around the world. They're going to treat super the exact same, albeit self-managed super funds have some actual residency requirements, but your
Mhm.
standard wrap structures and retail funds and master trust funds like Australian Super, Australian Retirement Trust, they're all going to be tax-free withdrawals, and then you're just going to end up paying taxes there over in the US. So not the greatest idea to make a lump sum distribution,
Nope.
especially given the tax rate there. You might just prefer to make regular distributions, drip feed the funds out, very much like what we would do on 401ks or US retirement accounts if you're living here in Australia and it's going to be taxed punitively if you take a big distribution over there.
Yep, absolutely. Can't improve that answer at all. Let's keep moving. That was great. Um,
No worries.
this one, I'm gonna just tweak some of the wording in this one because I think there's a couple of misspelled words here. But when should you trigger that you are a non-resident Aussie overseas for tax purposes? Um, it's simple, but it's also quite nuanced. And
Mm.
the clients also said, I know, but at what point in time when you've moved overseas, do you actually trigger that you become a non-resident?
Yeah, I get asked this one a lot actually.
Mm,
I mean, it really depends, and that's the blanket answer, and that's because
yeah,
there's no bright line test. There's
no.
no exact response that you can always give. Firstly, it doesn't necessarily come down to a choice. I can't choose if I've been living overseas for 10 years to say, oh, now I want to be a non-tax resident of Australia or a tax resident. It really
Mm,
comes down to the individual circumstances, your intention, but then also the facts of the matter as well. So I always go back to the four tests. So you got the resides test, the domicile test, the 183-day rule test, and the Commonwealth superannuation test. If you pass any of those tests, you're an Australian tax resident. If you don't pass any of those tests, then you're not an Australian tax resident. Intention feeds into those tests, and they're also not straightforward either. There's a lot of layers. It's like an onion. You got to
mm,
keep peeling them back and applying it to your individual circumstances. Generally, though, when you leave Australia and your intent is to leave with a degree of permanence, general rule is about 2 years there, then you would ordinarily become a non-tax resident when you leave Australia. So that day that you buy that one-way plane ticket to move overseas and you're going to live there for an indefinite amount of time, that's probably when you ended your Australian tax residency. But if you buy that ticket and then 2 months later you come back and you've still got your home and your family here, you've got cars registered in your names and you've got all of these connections that if the ATO was to tap you on the shoulder and say, hey, we think you're a tax resident, what are they going to
mm,
look at? They're going to look at all of these factors that influence where someone's actually living and where their life is, where their job is, where their occupation is, their family, these connections to substantiate whether or not you are actually a non-tax resident. Because
mm,
it's a self-direction, right? You file your tax return. It says at the start, were you a non-tax resident any time during the year? Yes or no. And then you put
mhm.
it in. Now it's really whether or not you're going to get asked by the ATO to prove that. And that's when they start digging through all of your situation, your personal movements, what you did and your life overseas. So really tough question. I
Yeah.
would say go and speak to the accountant. That's what our accountants are specialists in. And, it is a really, really important thing to get a concrete answer on. So let the accountant do the review over your circumstances. Don't just say, I choose today because today I feel like it or it's most effective from my income perspective, because that's one way to get a very easy, tap on the shoulder from the ATO. So at least
Yeah.
go ahead with conviction from the accountant's advice.
Ab Absolutely. I'm going to choose today because tomorrow I get a big fat bonus and I don't want the ATO to tax
That's
it.
right.
That's that's not how it works.
Yeah.
Absolutely. And yeah, tax residency, determining non-residency, if you're a resident or not, like it's just so convoluted and grey. I'm wondering whether with the budget that's coming out, whether we'll see the a revision of the new tax residency rules proposed once more. We spent a lot of time. We submitted obviously our consultation paper a long time ago when they brought those ones up, but it's really taken a backward step. However, uh, I'm not sure we will see it because it's not really a big revenue raiser for the Labor government. And given how much they're spending at the moment, I think they want to try and target things which are
Yeah.
actually going to raise money rather than just maybe pissing off the expats
Mm,
community. But we know that,
yeah.
yeah, yeah, yep.
Yeah.
So
I agree, mate. I
yeah,
think there's too much going on and too many eyes on them about other policies that they're probably going
yeah,
to let this one just sit in the background a bit longer,
yeah.
which is good, I think, for most expats at least.
Yeah, absolutely. Last question. This one, I think we need to unpack a little bit. So it's quite long, so I'm going to read it out as best as I can, and then we'll jump into it. So the first part of the question is tax residency purely based on the number of days spent in Australia? So I think we've just actually answered that question really well.
Mm,
Um,
mm.
I've just been advised by my accountant that I need to come back to Australia so that my residency for tax purposes does not change. I have a discretionary trust which holds two properties. My husband and I are the trustee and the beneficiary of this trust, and I'm being told if my tax residency changes to non-resident, I can no longer access the funds in the trust and that I'll be taxed at the highest rate. I do all this work. We do all this work to self-fund, and then we get hit with this. Um, then I add to this, I have an SMSF that also holds property, which will become problematic as well. Okay, a bit to unpack in this one. Let's start with the
Yeah.
trust,
Geez.
the trustee and residency, and then we'll get into the SMSF. I feel like that's an episode in itself, to be honest. But
Yeah,
let's uh,
definitely.
let's Let's focus on the first part.
Yeah. I mean, firstly, I feel for these guys because yeah,
Mm.
it's an unfortunate situation, and there's all these structures, so there's a lot of complexity that becomes involved, especially when you do become a non-resident. So the residency aspect, first and foremost, you can't just come back to Australia, spend 183 days here, and go, I'm a tax resident. You know, that's not how it works. They apply all of the tests. They apply facts to your personal situation and your intention. Was your intention to permanently return to Australia and spend, the foreseeable future here and be a tax resident? I think that isn't just a once-off, only spend 183 days and now I'm a tax resident and that's it. It is a test and it's something they can investigate. But, we've had people spend more than 183 days here and still be a non-tax resident. So it really does depend on the individual circumstances. So I think go get that fact checked with
Mm.
the accountant or with our accountant, with an expat specific accountant, absolutely. The trust residency. So that's an interesting one. So the residency of the trust will typically follow the trustee. So if you guys are the only trustees and you're living overseas and you become a non-tax resident, then the trust would become a non-resident trust. And associated with that, you can typically get the same treatment as if that was held in your individual name. So you would forgo the 50% capital gains tax discount. You don't get the main residency anyway, but you will pay taxes at non-resident tax rates. If you're a beneficiary receiving income from that trust, then you can still receive the income. That's for sure. It's not locked up
Yeah.
or anything like that. So
No.
squish that one out straight away.
Yeah.
But yeah, the income that is distributed, you pay non-resident tax rates because you're a non-resident beneficiary, which means
Mm.
that you pay a 30% on the very first dollar up until 135,000, and then it goes to 37, and then 45%,
Mm-hmm.
in the top bracket there. So not very great because you miss out on the concessions. So be mindful of that, and also the country you reside in as well, and how they treat distributions from trusts, especially if it's coming from a bucket company as an example, and whether or not that country will respect the franking credit that's attached to those dividends that are paid out. So the residency typically follows the trustee. So what do we do then? Well, there's a solution where you could potentially have another family member who's an Australian resident step in and be the trustee there, or if it's a company structure as well, you could step in and be the director, the resident director, and that allows it to remain an Australian trust. But there's still the issue that you as an individual might be a non-resident, which means
Mm.
that even if the trust is a resident trust and you still get the 50% concession, that's all great. You pay out a distribution to fund your retirement or to fund your lifestyle. You're paying non-tax resident rates on that distribution. So
Yep.
just be very, very mindful of those future distributions, and around that, the residency there of the trust itself.
Yeah.
Um, there was a lot in that question. Was that all of it on the trust, or was
It
there
was.
before we go
No,
into the
no.
self-managed super fund?
No, I mean, you've covered it very well there, and I think the accountant is obviously just trying to warn them and go, hey, listen, like we're going to lose all our tax concessions if we don't fix this. Like you
Yeah,
are
yeah.
trending towards this residency position where you're going to become a non-resident, and maybe the accountant could have unpacked the flow and impacts. This is the catalyst, and this is the change that we're going to see, and these are the negatives as part of that change. We need to look at a solution. The accountant should have also proposed a solution. If they are individual
Mm,
trustees,
mm.
then update the trustee to install a corporate trustee and, put a director on there that's an Australian resident, such as a family member. It's a form of rubber stamping, but it is allowed. Um,
Yeah.
and then, and that could help act as a bit of solution, maybe like a temporary solution for the next couple of years until maybe they return permanently. I think the accountant has let them down there and failed them in terms of giving them some good advice, unfortunately. But obviously, other good accountants could definitely help them. The SMSF. So we've
Mm,
definitely done episodes about SMSFs and running an SMSF as a non-resident. There was a warning put out earlier in the week or even last week about SMSFs and expats and non-residents running SMSFs, and how the ATO this financial year is actually going to be taking a closer look at that,
mm.
and the penalties for running a non-complying SMSF are severe. So why don't we just briefly unpack the issue that she's talking about here with running an SMSF as a non-resident?
Yeah, yeah. So it's whether or not it's, yeah, as you said, a compliant self-managed super fund, and SMSF. And there's three tests to determine whether or not it is compliant. So number one, it has to be established in Australia as an Australian resident. So, was it established? Sounds like it probably was if it's been
Mm.
running for some time and you've moved overseas. That's fine. You tick that one off. That's fine. Second one, central management and control. The central management and control, the decision making of what happens with the investments, what happens with the trust, the SMSF itself, it needs to be made from within Australia. Now, that doesn't necessarily need to be you. That could be another director who's here in Australia, perhaps, and they're doing the control and the decision making there, but it needs to be here in Australia. And then the last one is the residency test. So, you do have to be an Australian resident to be a beneficiary of those benefits of the self-managed super fund and have distributions. So there is a residency test for the directors of the self-managed super fund. There's an exemption you could potentially lean on. It's a 2-year exemption where you could live overseas for 2 years and then come back. So that is a temporary 2-year absence rule. But ultimately, if you are moving overseas, it's very, very common for our clients and expats that we speak to wind it up. So, I think you mentioned that there's property inside of this self-managed super fund. That would mean that, you would potentially have to sell that down, move it into something that, is a little bit more expat friendly. You don't necessarily have to move it into something like a master trust fund where you just lose all your control. If you like investing and having that level of ownership, you could use wrap administration structures. They're commonly used by advisors. We use a lot of those for our clients. And that could give you the same level of control or a very similar level of control, but sort of get rid of that residency in those three, tests and the restrictions that are associated with that. But it is a risk, absolutely.
Huge.
So just definitely be very, very mindful of that. And it's not the end of the world. It might just mean a bit of a repositioning of your superannuation fund. There could be some strategies there. If you're retired, maybe you convert it into a pension account first during this 2-year temporary absence rule, consolidate everything there. Now it's tax-free. It's tax-free sales on the properties there. Make some plans around that. If you're permanently residing overseas, maybe the super fund isn't the best vehicle anymore, and you could potentially consider some other things as well. Remember, shares are tax-free as well. So, that's a potential solution too. But there's some things you can do, absolutely. I think over this whole question, though, your takeaway should be there's things you can do. So from the trust, we've got clients who live overseas and they have a trust here in Australia. It's just about, understanding the consequences and then structuring it in a way to, as you said, James, rubber stamp it so that it either remains a resident trust or it serves a certain purpose whilst you're living overseas, and then you fix it up when you come back. Self-managed super fund, it's a bit stickier. There are things you can do by having directors who are resident directors, but there's some caveats to some specifics there. I'm not sure if you wanted to expand on that a little bit more, James.
It is a tough one. Like having an SMSF where maybe you've got a property or multiple properties in there, and you've got no intention of coming home, but maybe you've only owned those properties for 2 or 3 years. Like it's so expensive buying property in Australia when you factor in the other costs like stamp duty. God, stamp duty is a killer in Australia. It's ridiculous.
Raw.
But it is raw. It really is. Anyway, I won't go down that pole. But that being said, if there was an opportunity to restructure the SMSF with applying, say, and rubber stamping, doing the same, applying another director to the corporate trustee within the SMSF, then a really sort of last approach you would take is engaging a company trustee to become and turning it into a small APRA fund. Now that's really expensive, but it means you wouldn't have to sell the property. But I haven't seen like a real cost-effective trustee to turn into a small APRA fund. Essentially, usually they charge. I've seen some charge like 3 to 4% annually. So it's very expensive, and that's on the value of the SMSF. So you need to have the liquidity to pay those fees, and they charge a lot because they're taking on a lot of the risk, but usually it's a short-term solution. But you need to be really mindful of running a non-complying SMSF because the penalty is severe. The way the ATO looks at it, they give you 12 months to wind it up, but they will tax you at 47% or 45%, not the Medicare levy, 45% on the assets. So you lose almost half the assets and on the income, and they advise you to wind it up. If you don't do it, they'll hit you again. They follow up next 12 months if you have done it or not. So we know that based on some feedback from SMSF advisors and accountants, apparently this is actually something that's under the microscope this financial year. So when this financial year closes in 30th of June, when a lot of SMSFs are doing their tax returns and audits, that is something that apparently the ATO is actually going to be having a closer eye on. So just be mindful of that. Ensure you've structured it correctly. If not, then seek advice from your current SMSF accountant. If they can't advise, then obviously reach out to us. But that's something that you need to be mindful on. But I think based on this person's sort of questions, I think the accountant has really failed them here, really let them down. They could have given them some better advice, knowing that they've been overseas for a couple of years. They could at least help them restructure things so it can remain tax efficient, keep the concessions. So I really feel for them. But
Mm.
that's probably a good point there to what, sorry, Martin, you add to that?
Yeah. So I might just piggyback off that.
Yeah, yeah,
Last point
go
there
for it.
is consider the tax regime and the tax country you're in. Because if
Mm,
you're a tax resident of a place that taxes your entire global income and assets, that's a trust in most countries. They see your self-managed super fund as a type of trust. The US, great example. Foreign
mm,
grantor trust. You lose all of the benefits of a superannuation. You have look-through provisions. You have PVIC risk now as well. And if it's if bloody hell, if it's a property inside of that self-managed super fund, now it's a REIT, real estate investment
yeah,
trust, and now you've got to report all that. So be very conscious of the country you're residing in. Hopefully, this individual is somewhere where it's quite favorable. There could be, inheritance considerations in that country as well. So, both sides of the fence need to be accounted for here, not just the Australian and the Australian residency items there as well. So it is important that this individual does get the right advice here. So don't just pull the trigger on one bit of research or one piece here. Make sure you engage the right professional here.
absolutely, absolutely. And we'll put a pin in it and we'll finish there for today's episode. A quick shout out for all the Australians that came and visited the masterclasses in San Francisco as well as New York, and for those that we caught up with at the annual gala event with SF Aussies at the Australian Chamber of Commerce annual gala, 50th year anniversary. That was lovely. That was fun. And we'll be back over there very, very soon once more. Um, for those that are keeping an eye on the socials, there's a couple of webinars coming up that we'll be putting out, especially those around the budget, and another masterclass coming to you from Southeast Asia very, very soon. Um, in the meantime, Martin, as always, thank you for joining us on another episode. We'll get you back on very, very soon. And thanks for tuning in on another episode, guys. We'll speak to you very soon.
Lovely. Thanks, James.